This is Professor Hazer again, and this is the third problem that we do that is a full consolidation, but I don't show you the equity method. The first one was M4-1 on Brightspace, and that one was a problem that had a full consolidation, but it was first year and 100%. The next one was a similar problem, but it was first year, but it had a non-controlling interest. In this problem, we have a problem which both has non-controlling interest, but it's a second-year problem, so we might call it a multi-year problem. Okay, so this is going to be M4-3 on Brightspace. Okay, and so let's start going over this problem. There's going to be 4 videos. The first one, I'm just going to go over the problem. It's going to take about 5 more minutes. The second one, I'm going to do the calculations. In the third one, I'm going to do the consolidation entries. And fourth one, I'll do the consolidation. These things should get shorter every time. I'm getting more practice at these myself. Okay, so, although I've had years of practice anyway. You have PAC Corporation acquired an 80% interest in NCI Corporation for $480,000 on January 1, 2011. When NCI's equity consisted of $400,000 capital stock and $50,000 retained earnings. Now realize that the acquisition take place on January 1st, 2011, but this is going to be a December 31, 2012 consolidation. So it's a 2-year problem. Okay, now they're just giving you the goodwill calculation here, basically. The excess, the fair value over book value acquired was assigned to plan assets. So there's only one asset. What type? Plan assets. There's only one type of asset. It was undervalued by $100,000 and the goodwill. So basically saying the difference of the purchase price over the net book value is just going to be split. Part of it goes to plan assets, part of it goes to goodwill. Okay, and here's the financial statements right here, and these are going to be the same 2 financial statements that are going to appear on the consolidation. And we can see those. Basically, that's a full consolidation. Basically, those are the same 2 that will appear on the consolidation worksheet in these first 2 columns here. In these first 2 columns right there. Okay, now let's see what we got here. You've got a couple of things. You've got, notice there's the usual stuff, but there's $76,000 income from sub. So that's the parent's equity method income from sub that was recorded on its own books. And you come down here and you notice that they have an investment account. So they recorded the investment account using the equity method. So you know the parent has used a full equity method. As it turns out, this is an old CPA exam problem, and they actually wanted to trick you. So the equity method there's a slight error in their use of the equity method, but we'll turn that out. Okay, and so basically it looks like really a basic problem. But there's only 3 things in additional information that really matter. They owed each other $10,000, so that's going to be the old thing where we just debit accounts payable, credit accounts receivable for $10,000 because you can't owe yourself money. Apparently they owe themselves some sort of advance on one too, and the check was in the mail. You can tell this is an old book because no checks that go in the mail nowadays. But anyway, so that's basically another debit, a payable, credit, receivable. So it's like number 1. The thing that really matters in this problem is they wrote a mistake into it. They pretended that the parent had a bad account. And so you may want to keep number 3 in mind here, because number 3 is going to impact the investment account, because it says a $20,000 dividend declared by the sub on December 31, 2012 was not recorded by the parent. That means that the $20,000 dividend was not recorded by the parent using the equity method. So the parent forgot to make an equity method journal entry, so we're going to have to correct for that in the consolidation. Okay, so that's the first video here, but I want you, and I'll introduce you to, keep introducing you to the problem in the second part of the video, but notice that I'm going to finish here, but notice that these statements that you see here are the same ones that are going to be in the consolidated working papers. And Pat's statements are post-equity method. You can tell because there's an income from sub there and because there is an investment account for $560, although you'll see that there's just a light error in it. Okay, I'll put up this video and put these up one after the other. Thank you.